Hello everyone, welcome back to another quick video. I'm your host, Mayur Thaker. I am an analyst and senior relationship manager here at Zacks Professional Services. And this is a quick macro update on several leading economic indicators that I'm watching, as well as the state of affairs on the S&P 500, as well as other index earnings estimate revisions that we've been seeing here. This should be hopefully a timely update on where we're headed, from a macro standpoint, as well as how are we doing so far with earnings on the S&P 500. So let's get started. As we've been talking about before, this is one chart that I've been watching very, very closely. Inflation is at front and center on basically every earnings call that we're hearing, especially from bellwethers such as banks and industrials. Input costs have been rising all across the board, from commodities prices to energy prices and transportation costs, things like that. So obviously the CPI index is kind of the, encapsulates all of that. We saw that the headline number hit 8.5%. That basically takes us way back to 1980, to see a higher CPI growth year over year. And remember, this is something that I've been talking about for quite a while now. I believe the CPI will remain elevated so long as the backlog remains elevated. But we did see a downtick in the backlog. Now it has been kind of seesawing. At least, the growth of the backlog has stopped since the height of last summer, and it's been coming down since then. But as you can see here, that it upticked once again in January of this year. Kind of reversing the downtrend that I thought was a good sign for CPI to come down. But then we upticked right here in February, and now we downticked once again in March. So let's see where this backlog really takes us. Remember, the backlog is key to solving the inflation problem, because so long as factories and manufacturing is unable to keep up with demand for finished goods, we're going to see the CPI remain high. And it's just that's just how things work with regards to supply and demand imbalances. And as you can see here, the backlog has had a very strong positive correlation with the CPI, going back to the late 90s here. So this is something that I think is very worth watching closely, to have a better understanding and a leading indicator, sort of a heads up on where CPI will go. So, if the backlog does come down and take out that low that we saw in January of this year, if I, display that, zoom in a little bit here, you can see that it hit a low of 56.4 as of the January 2022 reading. If we take out that low, then I think that would be a great sign that, perhaps the CPI has peaked. So a lot of folks are calling for that right now, that perhaps the CPI has peaked and we're going to see that come down. That would be very bullish for stocks going forward, because then that would mean that estimates, earnings estimate revisions can come higher as input costs ease in terms of their inflationary pressure. So that would be bullish for stocks, but let's see where this takes us. I want to watch this and see this come down, below this level here at 56.4. before I start to make a top call on the CPI. Other indicators that I'm watching as well, you can see here that alongside where backlog has been going, we can see in inventories, for example, business inventories are at all-time lows. That's also something that to keep track of as well. Remember, this all makes sense because remember, as the backlog hits, 25 plus year highs, at the same time, inventories have been cleaned out. We've seen the lowest levels of business inventories really since we've been tracking this statistic from the Institute of Supply Management here. So this is the lowest level. Now it has bottomed here. It looks like it double bottomed once in the summer of 2021. And again, in November of 2021, and it's off the lows there, so that's good. We can start to see, business inventories start to replenish themselves, but it's still very, very low. Remember, so that's also one of the factors to inflation is that backlog remains high. That means factories are unable to keep up with demand. And as a result of that, inventories are extremely low. So these are kind of coincident indicators. So as the backlog eases, inventories should rise. As inventories rise, prices should fall. So all of these numbers are, things that I'm watching here. Other indicators that I'm watching are the leading economic indicators. These are well-known, indicators for the state of the macroeconomy. One of them are initial claims. Initial claims have been very reliable in the past to give you a heads up on whether a recession is coming. And so far, we've had, the exact opposite, right? Inflation, the initial claims index has basically hit all-time lows here, down to about 171,000. That's well off the peak of COVID. So that's, definitely great news. We're headed in the opposite direction here. And you can see that historically speaking, initial claims have started to move up right before the onset of a recession. And we're on the opposite end of that extreme. So that's very, very good to see in terms of, keeping recession at bay. Interest rate spreads are also super important as well. They've had a phenomenal track record at, predicting recessions. And the spread between the 10-year Treasury yield and the 1-year Treasury yield is elevated. So that's really good. We don't want that to get inverted. As you can see here, every time it's dropped below zero, meaning, yield curve inversion, that's been a very, very strong forward-looking signal to a recession. So far, we're still well above water here, so that's really, really good to see. This can wax and wane a little bit just due to, market dynamics, but, as long as it does not continue to trend down like it has been over here, and as long as we remain above zero, I think these are, perfectly healthy numbers. Same thing with, new orders, right? Durable goods orders. This number is up 10% year over year. So again, not a whole lot of evidence to suggest that the economy is slowing. And if this starts to pick up, which it looks like it has just ever so slightly, again, that's very, very bullish for the demand side of the equation. So again, from the demand side, everything looks like it's, moving along quite well. Factory orders also remain strong. They're basically at their long-term trend. So, the inflation that we continue to see, to me appears, based on the data that we're looking at here, all appears to be from the supply side. Factories really need to start to come on. The logjam at our shipping ports really need to ease up. When the supply chain disruptions are eased, that's when I think inflation will start to come down. But until that happens, inflation will just continue to remain high. And if it remains, if it goes much higher, perhaps inflation will be the leading cause of demand destruction. And then we'll start to see these types of, durable goods orders, factory orders start to roll over. When that starts to roll over, initial claims will start to rise. And that's what will trigger, a recession. But so far, we haven't seen any evidence of that happening. So these are all numbers that we should keep an eye on. So far, so good, is basically my sort of takeaway here. Also, we want to keep an eye on building permits, right? So new housing, starts. So far, we're kind of, teetering between positive and negative here. We saw, housing prices really hit, extreme highs. That might start to cool off a bit. So perhaps building permits start to flash a early warning sign of a recession, but perhaps that could just be because of, the housing market running red hot for a little bit too long. So we could have a situation where, building permits are a one-off, meaning this one will start to show, flashing a recession, but it's not being confirmed by other leading economic indicators. So that could very well occur where, building permits start to show recession, but others are not confirming that recession. So again, all really good numbers so far. So ones that you definitely want to keep track of. I want to bring another chart to your attention, which is labor productivity. This is absolutely fascinating because we can see here that as we have moved back to long-term growth, and I'm trying to find that chart here. Should have actually created a pitch book. This would be a great sort of example of how we could use pitch books here. Let's see, where were we here? Apologize, I had a chart here that was showing labor productivity, and I think it's definitely worthwhile showing that, but I can't seem to find that here. Let me come back to that if I could, if I do find that here. Fed funds versus inflation, Chicago PMI. We looked at that before. We can come back to that. We'll come back to that. Apologize for that. The other thing that I wanted to also highlight, and this is one of the reasons why I think the S&P 500 has been so incredibly resilient in the face of all of this, in the face of inflation, in the face of geopolitical tension, in the face of soaring commodities prices, is that the S&P remains the best game in town. Look at where efficiency is for the S&P 500 companies. We're looking at operating profit margins here, EBIT margins. And EBIT margins are hitting basically 25 plus year highs here. We've never seen a time period where companies are more efficient than they are today. Even despite inflation, remember, this is operating profit margins. So this is considering all wage inflation, all input cost inflation, all transportation inflation, all other forms of inflation. And so we're now looking at, operating margins that are essentially at 25-year highs. This is absolutely incredible to see here. If we go down to net margins, it's the same exact story. Net margins at 20%, almost 20%. That represents a 20 plus year high again. Now, if I were to change this over to remove the tilt sectors, remember a big part of why the S&P has been so strong is because the energy and materials sectors have been extremely strong because they are direct beneficiaries of commodity price inflation. So if I were to remove those and go to the Zacks standard industrial proxy, this is the core industrial component of the S&P 500. So basically, the S&P minus those tilt sectors, such as energy and financials. And you can still see that these companies are also at 25 plus year highs in terms of net margins. Absolutely stellar performance by corporate management here in guiding these companies towards record profitability. If I were to go over here to cash flow margins, remember cash is king. Net margins are fine, but it needs to be confirmed by operating cash flow. And you can see here that that's also being confirmed. 15% plus cash flow margins. That also represents a 25 plus year high. If I were to go to free cash flow, check out, that. We're off the highs here, but still, 25 plus year highs, basically. Off the highs, which were set just about a year ago. These are just extraordinary results coming in by not just the S&P 500, but even the subsections of the S&P 500, even after removing energy and materials as well as financials. Remember, energy and materials are the ones that have benefited the most from inflation. Those are short-term factors. So even if we were to remove those sectors that temporarily go up and down, we're still seeing spectacular results from the core industrial component of the S&P 500. This is why the S&P has been so resilient, despite all of these, setbacks, in the macroeconomy elsewhere, in inflation and geopolitical tensions. So as long as this continues, I think this is going to be why stocks remain the best game in town. And then if we look at estimate revisions, if I were to go over here to the estimate section under EPS FY1, FY2, You can see estimate revisions remain very, very strong for the core industrial component of the S&P 500. 13% plus revisions over the past 1 year for fiscal year 2022, 7.5% for 2023. So this remains very, very strong in terms of a positive earnings estimate trend. If I were to switch over to the S&P core, right, the overall S&P 500, that's also being confirmed here. 10+% revisions for the S&P 500. And you can see here that if I were to switch to the macro S&P, this is the bottoms up recreation, whereas the XPX is the top down. You can see that the estimate for 2022 by analysts remains about $226.88. Right now, the S&P is trading at roughly 44.72. Basically, we're at less than a 20 PE multiple right now. That's, to me, very, very normal. I mean, this is not any indication of a market-wide bubble. We're basically at 19.5 times this year's earnings. And for companies that are setting record high profit margins, as well as record high returns on invested capital, we're basically at a juncture of time here where companies have never been more efficient, have never been more profitable, and have never been more capital efficient either than ever before. So this is exactly why the market has been resilient. Strong estimate revisions, strong profitability, strong returns on capital, and a multiple that's really not outside of the norm here. So if I were to go over to this chart of forward-looking, PE multiples, again, this is not, outside of the norm of, it's really not outside of the realm of possibilities here. We're neither super expensive nor super cheap. We're right, just about right where we should be. Currently at, 18, just under 19 times forward earnings. The median over this entire 30-year period has been 16.5 times. So, although we're above the median, it's really not anything to be, concerned about at all, given the state of where we are with estimate revisions, margins, and returns on capital. So that being said, I think Q1 earnings is going to be one of the most important earnings cycles in recent memory. As we get updated commentary on, from management on inflation and how it's affecting their businesses, updated commentary on how the Russia and Ukraine conflict is affecting their businesses, and, basically clear guidance for the rest of 2022. So we will be watching that very, very closely here, but so far, so good. I don't see any evidence of recession. In fact, I see evidence of strong, economic acceleration thus far. I see pretty strong evidence of earnings thus far. So as long as that does not change, I don't see any reason for why the S&P should be entering a bear market anytime soon. But we will see as we go along here. So far, so good. That's all I had here for today, guys. Thank you so much, and hope to see you again for our next call. Take care. Bye-bye.